Today is one of those days in the markets where there is so much bad news. There's no real way to sit here and make a video and make it sound all pretty. We can't do that. So we're just going to get into what is happening today, why this is so bad. It's like so bad. Everything is going wrong. Stock market is down over 0.5% on the SPY. The NASDAQ is still down over 1%. By the time you guys watch this video, it wouldn't surprise me. After all, we are in 2022. If the stock market is up or down 1% to close out the day, that would be pretty incredible if we were up 1% to close. But we'll see, guys. I don't want to waste your time. Let's get straight into this video. This is definitely a video you want to help push out by hitting that like button and subscribing to the channel because people need to know this. This is people's money. This is your money. You need to know what is going on. And not just the stock price or the chart. You can look at that S&P 500, see it's going up a little bit right now, but it's so bad you can't even put it into real words. So exactly what is happening today? Well, there's a lot that is happening today. Europe on high alert as Russia temporarily halts gas flows via major pipeline. Operator Nord Stream 1, the original, confirmed the maintenance work, which is scheduled to run from Monday through July 21st, got underway as planned on Monday morning. So the pipeline will be shut down for 10 days. Russian gas flows to Germany are expected to drop to zero later in the day. Klaus Mueller, the head of Germany's energy regulator, believes the Kremlin may continue to throttle Europe's energy supplies beyond the scheduled end of the maintenance works. Basically saying they might just keep it shut down longer. They might make up some excuse. And a lot of people are saying that if that were to happen, dude, inflation, your energy cost, a recession, that is here like 10 days from now. That's it. If there's no more energy coming from Russia, you need bailouts, massive bankruptcies, like just an overall, can I say it, shit show in Europe very, very quickly. Europe is not in a good situation. Unlike America, they don't have their own energy reserves, so they are dependent on Russia, and that could wreak havoc for global markets. So you have that. You also have the 2- and 10-year yield curve that is now at a new low for the inversion of 2022. We are now at negative 0.08. So that is up from 0.02, call it the last trading day, Friday. So you are up like 300% today, which is very bad. This is one of the most relevant indications of a future recession. As you guys know, actually on my birthday, April 1st, first time we went negative for 2022, we were inverted at the low of negative 0.07. Now we're negative 0.08. So markets are actively pricing in a recession right now. The yield curve is massively inverted. And specifically today, it went massively inverted today. Like minus anything else. We've been inverted for a while now, for at least the past couple of days, but today was a big move in the 2- and 10-year spread. So you have that. You also have home buyers that are canceling deals at the highest rate since the start of the pandemic. Key points: Americans are canceling deals to buy homes at the highest rate since the start of the COVID pandemic. The share of sale agreements on existing homes canceled in June was just under 15% of all homes that went under contract, according to a new report from Redfin. Home builders are also seeing higher cancellation rates. So, not good, right? And you could kind of compare this to fear. When there is a lot of fear in just the economy, fear that you potentially might lose your job, the last thing people do is sell their house, right? Because after all, if you sell your house, what are you going to do? You either have to rent or you have to buy a new house. If it's hard to line up, right, selling your house, buying another house, job uncertainty, well, a lot of people are canceling, and it is the highest share of the market, the real estate market, that is being canceled since 2020. It says that is the highest share since early 2020 when home buying paused immediately, albeit briefly. Cancellations were at about 11% 1 year ago. So not good, not good. Definitely showing signs that consumers are fearful and weakening, like I said. Now, we did get a lot of surveys today from the Fed. New York Fed survey, a growing portion of U.S. consumers believe credit has become more difficult to obtain in the last year and will remain that way in the coming year. U.S. consumers, on average, see 40.4% probability of higher unemployment rate in a year, highest since April 20th. Again, people fearful about job security. That is one of the biggest things that can send you into a recession, potentially a depression, is when people stop spending money. They start saving money because they are fearful about potentially losing their jobs. Another New York Fed survey says more than half of American consumers say their household financial condition has worsened in the last year, and nearly half expect it to worsen in the coming year. Along the same lines of what we just said, job stability or instability, I should say. People are concerned. People are slowing down. People are sending us into a recession, as well as inflation, as well as the Fed. So that's the long story short with all of that. We also did get some bad news out of China. We have 3 cities in China impose partial lockdowns as new cases are reported. Cities of Jian, Lanzhou, and Hikyu set restrictions on several million residents. In Macau, the gambling hub, authorities shut casinos and ordered everyone to stay home. And this is definitely affecting the markets today because of obvious reasons, right? Global recession fears. Not good when the second largest economy in the world is shutting down cities with millions and millions of people in them. But what is even more concerning is some of the bank runs we have seen with Chinese banks, especially over this weekend. This article just came out a couple of hours ago, not too long ago. And it says that the videos posted on social media on Sunday showed a large crowd of angry Chinese bank depositors protesting outside the Changshu branch of the People's Bank of China after their deposits were frozen in April. As much as 2.2 billion yuan, or US dollars, but 51.5 billion wons are being held, 2.2 billion US dollars. So there's a real question of what is going on in China. We know their economic data, is botched. We're not getting accurate numbers out of China, so who knows what is going on in the second largest economy in the world, which is also, again, going to feed into potential fears about a global recession. Now, guys, the biggest thing that is worrying me, that should worry all of you guys, and not worry me in the sense of, stock market going down, freak out, depression for 20 years. Not in that sense, but in the sense of people think everything is fine. There's a big divergence between, people think everything is fine. More people are getting comfortable with the situation where we're sitting. More people are even getting bullish from what I've heard of. Whereas the economic data, what is actually happening, is getting much, much worse. Much, much worse. Take a look at this. The most concerning chart for the odds of a global recession. Guys, we are already in one. This is UUP. This is an ETF that tracks the price of the US dollar. Well, what can you notice from this chart? Let me just tell you. This is the COVID crash. This is March of 2020. What happened with the US dollar? It rose sharply. Why was that? Well, because people want US dollars when there is fears of a recession, global instability, for a lot of reasons. But it's never good, right? If people want the US dollar and we just printed 35-40% of the M2 money supply in the past couple of years, why do people want the dollar? Well, it's because people are fearful about a global recession. And we actually hit 28.90 during the COVID crash. Guess what we hit today, guys? 28.90, and we're about 5 cents under that right now. It's been a pretty much continuous gap up over the last couple of weeks, specifically over the last couple of days. The dollar has been strengthening like no other. Now, this gets a little bit deeper into macroeconomics, right? When the dollar strengthens, if you are Apple or Microsoft doing business overseas and you have to convert your wons or yens or other currencies into US dollars, Well, if those global currencies are weakening compared to the dollar, and it now takes more of that currency to equal, say, $1, well, earnings for US companies will get destroyed. That is why Microsoft, about a month or two ago, came out and revised their guidance to the downside, was because of the foreign exchange rates. Well, since then, look what has happened. We are much higher with the US dollar. And that is also, besides the financial impacts, like I said, it's showing you fear in the world. If the US dollar continues to break out, if this thing continues to go higher, this will mean a major divergence in the stock market that we will have to go much lower in equity markets. There's that one. And this is very, call it concerning for global issues, for a global recession, because what this is showing you is currencies on the world stage are getting devalued and people are running to the dollar. Never a good sign. The higher this goes, the more potential downside we could see in the stock market. Okay, that's the Econ 101, long story short. But what is also happening is we're still seeing a 7.6% chance of a 1% rate hike. This would mean a lot of downside. This would mean another 15 to 20% move down in the stock market if we get a 1% rate hike. Now, why is that, you might say? Well, that would put the federal funds rate in between 2.5 to 2.75%. Guess what a 10-year bond is paying you? 10-year bond is paying you 3% to put your money up for 10 years. The Fed reverse repurchase agreement program, if it's going to pay you 2.5 to 2.75%, why would you put your money up for 10 years? You would not do that. So bond yields would have to go up at least 50 to 100 basis points, 0.5% to 1% in a very short amount of time. Now, what could solidify this? What could solidify a 1% rate hike from here? Because think about what happened last CPI report. Let's take a look at the S&P 500 chart. I'm sure some of you guys are scarred right here where we were sitting in, the 410s, 415 level. We got a really bad CPI report. It came in, 8.6% year over year inflation, a new high. Well, the stock market ended up dropping. Let's go ahead and chart this out. From the high around that time to the low, about 13% in the course of 4 or 5 trading days. Not a very long amount of time. I mean, you were seeing down 2 to 3% days pretty much back to back to back. And that was because of the CPI report. And that was also because we got the CPI report on a Thursday, and then we ultimately got the Fed that next following Wednesday, and we went from a 3% probability of a 75 basis point rate hike to a 97% probability of a 75 basis point rate hike from the Fed, only in just 2 days. And then that's what the Fed did. So whatever this is pricing in, the Fed rate monitor tool, whatever this price is in, coming down to the FOMC meeting, which is 2 days, the 2 days before the Fed actually raises rates. So that meeting will be July 25th through July 26th. If this bad boy is over 50%, the Fed is going to do a 1% rate hike. And like I said, that would drive up bond yields and that would drive down stocks in a massive way. But what is actually going to solidify that? Well, I think this week could be a big factor. And I think this could really, like I said, help solidify a 1% rate hike, push us over 50% probability. The inflation rate, CPI, coming on Wednesday. We're expecting 8.8%. Last reading we got was a new high for 2022 at 8.6%. So this would be, again, indeed, a new high for year-over-year CPI. Some people expect this to come in over 9%. Some people expect this to come in at 8.5%. As long as this thing comes in higher than 8.7%, if we get a new 2022 high for inflation, the markets are going to freak out. Either way it goes. Anything over 8.6%, markets freak out. If we come in over 9%, you're going to see a big freak out. And that's also going to, like I said, push up in real time the probability of getting a 1% rate hike. And then on Thursday, you have PPI. If you don't know what this is, it is producer price inflation. If this comes in over 0.8%, the last reading that we got last month, well, you're going to have problems. We're expecting 0.9%. Comes in higher than that, you got some problems. You have initial jobless claims on Thursday as well, Fed Waller, some other smaller data points. It's not going to move the thing that is going to dictate how the markets move, which is what the Fed is going to do, which is that 1% rate hike. On Friday, this is where you could solidify the 1% rate hike. This is where you could see the markets take a 4 or 5% massive dump. Retail sales, month over month for June. We are expecting 0.5% gain for month over month retail sales. Now, if retail sales come in better than 0.5%, if we come in at, let's say, 1% for retail sales, showing that the economy is doing good and we have high inflation, well, that's going to say, hey, the Fed can raise rates by 1%. Or maybe the Fed needs to raise rates by 1%. And we would get the federal funds rate monitor tool pricing in a 1% rate hike by this next upcoming meeting. Now, at the same time, if you guys want to look further down the line, we know Fed raises rates July 27th, possibly a 1% rate hike. If I were to imagine, probably going to be a 1% rate hike, July 27th. July 28th, advanced estimates for Q2 GDP essentially telling us, will we show that we are already in a recession? And then on the 29th, 28th, 27th, 26th, 25th, that whole week, you're going to get large company earnings, which the estimates for those earnings have not come down at all. So we are expecting record margins, even though the US dollar is strengthening and your foreign exchange rates are going to hurt American businesses that are based in America. Just any American business. Going to be hurt. Margins, that's going to hurt margins. But yet, analysts keep their margins at all-time high levels. We're expecting all-time high revenue, all-time high earnings, profits, right? Well, what are we getting as far as economic data? You're getting negative 1.6% Q1 GDP, a negative 1.2% estimated Q2 GDP print. You're getting bad retail sales, just bad consumer data. People are freezing, selling their house. They're taking their house off the market because they're fearful about the employment market, just people slowing down, right? A recession. All of these negative factors, even Microsoft, like coming out and guiding down lower because of foreign exchange rates. All of this, record margins, record earnings, record revenue, that's what we're expecting. If we get anything less than that, anything less than perfect, I mean, I think it's clear. We've seen it already in 2022. That's not going to be a good thing. Mix that on top of everything else. I don't think it's possible for the month of July to be good. I don't think it's possible to not hit new all-time lows unless CPI comes down in a really big way on Wednesday. Which, if that happens, forget what I said. You might start to price in a 50 basis point rate hike instead of a 75 basis point rate hike. That could be very, very bullish. But as far as right now, you're in a really bad situation. And the markets are not accurately reflecting that in the day-to-day price action of the S&P 500. In my opinion, this is going to culminate into a 5, 6, 7, potentially larger percent down day. Kevin O'Leary said what he expects to mark the bottom is a 3,000 point move down in the Dow. The Dow is sitting at about 30,000. That would be a 10% down day for the Dow, likely NASDAQ and S&P 500 to mark a bottom. This data, if it continues to go like this, if the dollar goes higher, if 1% starts to get priced into the federal funds rate, it's possible you get a 10% down move. I wouldn't go out and, die on that hill, but it's possible. So that's what I have for you guys here in this video. It's concerning to me that the markets are not reflecting the data that we are seeing. And I think people are probably going to lose a lot of money betting, market, everything's fine. And hopefully this puts it into perspective how bad the situation actually is. So that is going to be all for this video. Hit that like button and subscribe to the channel if you guys found value out of the video. Thank you guys for watching. I will see you in the next one.